I'm Charlotte McLeod with the Investing News Network, and here today with me is Paul de Sousa, Senior Vice President and Investment Advisor at Sightline Wealth Management. Thank you so much for being here online with me today.
Thank you. Thanks for having me.
Yes, and it's great to talk to you again. We're here today to talk about the US election and how it could affect Canadian investors. Before we jump into what could happen right now or in the future, I want to take a look at the past and ask you how the US and Canadian stock markets tend to interact with each other.
Well, there is a high correlation. First of all, the US is much more diversified than Canada. Canada, you can consider it oil and rocks. As the economy comes out of a recession, Canada will do well due to its natural resources. So it's pretty much a cyclical stock market. In the TSX, I think, has about 28% financials with banks and insurance companies. As rates rise, they will do well. I don't see rates rising in the near future. And there's materials, mining, agriculture, and a small tech component, about 9%, and healthcare is about 1%. So when the U.S. is slowing, Canada will slow. And when the U.S. is growing, then Canada will grow. So that's generally how they interact in the past.
Okay, and taking that a step further, does it usually tend to matter for Canada which party is in the White House? What does history tell us there?
Yeah, I'm not so sure history tells us anything. If we look forward, monetary policy will be loose, fiscal policy will be tight. There will be increased taxes corporately and individually as well. That's going to create headwinds. And so generally that will not be good for Canada for that reason, in terms of probably see the US slowing down and thereby the TSX slowing down.
All right, looking a little bit more specifically at this year's election, we had a few long days of counting. It has been called for Joe Biden at this point. I think first it would help us understand what that could mean for the stock market in the US. So what are your thoughts there?
I see dark days ahead, and I'm actually quoting about 2 or 3 days ago, Biden was insinuating that there would be further lockdowns as COVID-19 cases rise. And so that won't be good. He'll be taking a much more serious approach towards COVID-19 than Donald Trump has. And so what that means is volatility, uncertainty, higher taxes again, personal and corporate, even in Canada. I mean, we all have to pay for this. And I believe in Canada, we spent the last year 1/4 of the debt that's taken 150 years to actually accumulate. There's a new green agenda. That rhetoric is growing a louder voice, and elimination of cars, air travel. They want people to stop eating meat, lower carbon, more renewable energy. Look for this narrative to strengthen. And so, there's a bit of uncertainty. I mean, Biden is likely the winner. There's still a bit of uncertainty with recounts and legal challenges, but he's pretty much in office, and a lot more volatility, uncertainty.
Right. So we know definitely that there is uncertainty coming. What does that mean, assuming we do end up with a Biden presidency, for investors in Canada? What should they be looking for or be aware of? What does it mean for them?
Well, I think so. Canada, I think first thing for investors to understand or realize, I mean, there used to be foreign content restrictions years ago. So today, a Canadian investor is not subjected just to purchasing the TSX. I mean, there's that hometown bias where you want to, but they have options. They have a blank canvas for their manager and investment selection. So having said that, I mean, on the camp that the TSX will be flat, there'll be some subsectors that will do well, and we'll probably get to that in terms of precious metals. And so there will be, I think this is in the early periods of the transition from this new green agenda, from the current agenda, from carbon to this new green agenda. it'll be similar to when we move from agriculture to the industrial process. It'll take a long time. It's almost like watching your children grow. You can't quite see it, but it's happening, and it is happening now. So investors would be wise to understand that this is happening. It is a reality. It's not going away.
For Canadian investors, what's the best course of action at this time? What kinds of questions are you getting from your clients?
So I think Canadians have some work to do, and we're meeting investors every day that have outdated, under diversified portfolios. What I mean by that is the 60-40 portfolio of equities and fixed income, and it's laden with risk. Right now, there is an imbalance between risk and reward. It is asymmetrical. One is not compensated right now for the returns given the risk that they're taking. It's quite dangerous. Interest rates at these low levels is causing a war against savers, a war against investors, a war against retirees. And I find investors are suffering from the acronym is TINA, T-I-N-A, and that is there is no alternative. And that's why equities, partially why equities are rising, is rates are so low. It's quite upsetting to see investors unknowingly sometimes taking on increased risk because they're just desperately needing returns or income. So I'm here to say that there are options. Look outside the traditional 60-40. And there's several other asset classes that provide yields that they are seeking. Seek out a qualified advisor who has a great deal of experience in doing the due diligence and monitoring of these asset classes. There will be a lot of investors seeking out these asset classes, but they'll probably be in the right asset class, but selecting the wrong investment. So there's a lot of work to do there. So feel free to ask me more questions on that. I think we can go on there for a while.
Yeah, maybe you could give some examples of some of those assets that people might want to look at that go beyond that traditional breakdown.
Right. So, I mean, if we look to what endowment funds and pension funds have been doing for the last, say, 20 years, it's increasing their allocation to non-correlated private investments. And they're providing stable returns, and it comes with what's referred to as liquidity premium. One must know that they're not as liquid as a daily traded ETF or a mutual fund with a T+2. Some have a notice period of 1 month notice in order to redeem. Some have 3, 4, 6, 12, and the private equity space, it could be 3 to 8 years, depending on that. So it's really important to have a financial plan actually mapped out in terms of knowing what your cash needs are, what the known cash needs are, and maybe the unknowns. I would also caution investors in retirement or very close to retirement to set aside a few years of income already in cash. You want to avoid drawdowns in your portfolio. You end up in that negative black hole risk, and it's so difficult to come out from under. And there's an article I wrote back for the Globe and Mail that kind of outlined, if you have a few years of losses, it takes so much more time to recover from that, and your longevity could actually be lessened by about 15 years. Where in terms of you had enough income in your portfolio to last you until you're 90, 92. However, 2 or 3 large losses really draws down on that, especially when you're, say, riffing and removing income out of your portfolio. And so I can't stress, again, going back to these investments, is don't just allocate to them. Find out someone qualified to do the rigorous due diligence. These markets are very inefficient, which provides a lot of outsized opportunities, but you have to enter the correct ones and be mindful of how much liquidity that you're willing to, give up.
Right. And maybe you could talk a little bit about the timeline here. Like we've been talking about how there's a period of volatility coming up. How much time should people be urgently trying to get their affairs in order, or do they have some time is actually interesting. We did a poll on our for our Twitter followers before the election, asking people if they feel comfortable with where their portfolios are at, and a surprisingly high number of people said they do not. So
I'm glad to hear that. Now, the next question is, what are they doing about it, right?
exactly.
Yeah, so I do find it's interesting. Apart from COVID-19, I think people generally lived in a era of complacency where bad things happened in other countries to other people, but not here. And so I think, as terrible as this virus has been, I think it's caused a lot of people to take their financial affairs a lot more seriously. I know, speaking to our estate planning partners that we deal with, they've never done so many wills in 1 year in their entire career. So people are now feeling, mortal, that things can happen. So that's great, because typically people, Michael Lewis has a fantastic line in one of his books, The Big Short. He says, "Don't wait until you see the whites of the eyes of crisis before taking action." And so the next thing is, if you don't have a plan, have a full plan created in terms of mapping out all liquidity needs. I find individuals sometimes taking on a lot more risk than they actually need to. They're aiming for a higher return, and when you show them you're actually okay with a 4 to 5% return, so you dial it down, and they live comfortably. And some people actually have so much, too much money, and they're living way beneath their means. So it can be helpful both ways. And then seek out. There's excellent asset classes. I should remind everyone to probably look at institutional quality. There's a lot of private investments out there, and it has to undergo the rigors of institutional quality due diligence. Not these, I don't know. I just see so many of them that probably wouldn't pass a 5-minute test in terms of if it's quality or not. So really seek those out.
All right. And I think we should also probably talk about gold. It's something we've talked about in the past. This week, we've seen gold reacting to the election. We've seen some reaction to the vaccine news that we got. What is your take on that activity? Can you tell us what you see there, and if these factors are really that important for gold in the long run, if there are other factors that investors should be more aware of?
Yeah, look, I'm firmly in the camp that gold is a permanent asset class. And I'm talking about gold is that allocated gold bullion, not mining stocks. Mining stocks do have a place in portfolio, but they represent a different asset class, believe it or not. Gold is gold bullion, and precious metals are not. I have the analogy too, as well as if you're buying insurance, you're buying an insurance policy through, say, an insurance company. You don't buy shares of that insurance company. So I think that's a quick way to realize that they are two very different asset classes. Look, the world's been on a debt binge. This is Keynesian economics versus Austrian. And there's so many reasons in terms of to guard against fiscal imprudence, monetary instability, financial markets instability, protection of purchasing power. And I think most importantly right now, it protects against negative real interest rates. I mean, if you factor out inflation, where interest rates are, there's a negative real return here. So gold thrives in that environment, and I do firmly believe interest rates will stay low for a long time. Jim Sinclair wrote this, I'm going to guess 2006, possibly 2005. He had a really amazing post about over-counter derivatives and how these are unregulated. They are, it's binary. There's a winner, there's a loser. They amount to probably in the trillions. And there'll be a daisy chain of effects in terms of, one counterparty fails and there could be others because they all owe each other money. The most important thing I think he wrote was 85% of those are interest rate sensitive. And so if rates rise, and these are lower counter derivatives, which are not, listed options or derivatives. These are financial bets. So 85% of those are interest rate sensitive. And so kind of reading between his lines, it's rates got to stay low because if they rise, there's going to be a lot of trouble there going on. So unless there's a massive coordination between these counterparties or these parties engaged in these to extricate themselves from this, because it's best probably. I don't know if that's happening or not. It would make some likely sense. And then once that happens, maybe then rates can rise. I don't think they can go up substantially. The economy is too unhealthy for that, and that's what people don't realize. Rates, it's a monetary tool to lower rates to stimulate the economy. So people are thinking everything's rosy, but rates are at rock bottom. So there's that massive disconnect between, we've all read it now, Main Street and Wall Street.
Right. And, speaking of a disconnect, I think that, a lot of the time people want to see a higher gold price and don't necessarily realize what that means for what else is going on in the world.
Yeah, absolutely. Yeah. And, it's one of those investments you really don't want to actually go up in value, because that means, there's something else, terribly going on. Look, the world's not had a successful fiat currency. Right now, I think the two longest standing currencies are the US dollar and the British pound. But if you look at their purchasing power, they're abysmal failures in terms of what a dollar would purchase at any point in time in the past and what that same dollar purchases today, and basket of goods. So gold is that protection. I know all the quote unquote gold bugs will, hope for a gold backed monetary system. Actually, I don't like that term, by the way, gold bugs. I find it's just because I say I eat salad does not make me a vegan. So just saying if I buy gold, it doesn't make me a gold bug. I think it's when you understand it and when you follow its monetary history, the fascinating read. And I think few people, I think more people today, but few people truly, especially investors I speak to, don't really appreciate that. When they do, they understand. I think a lot of lights turn on and a lot of dots are connected, and a lot of things make more sense. Because to the average casual investor, they're super busy with a family, their businesses, and life. And deep down, they know something's not making sense, or a lot of things don't make sense. And what is it? So I find that having this discussion really cements that what they in their gut knew something was just not right.
All right. And any final advice you would share for investors as we head into the final 2 months of the year, which are likely to be probably full of turmoil?
I'd say, if that poll is correct and they think that, sorry, what was the answer again? That people don't think everything is right. I would say, great first start. Now take action. Make a conscious effort to diversify your portfolios. Look at the correlations. Look, you can have various equities from different parts of the world and different sectors, but at the end of the day, they're all correlated. So look for add bullion to portfolios, a little bit of mining stocks, and definitely look at private investments and even hedge funds as well. Markets don't go up all the time. Therefore, having a manager or strategy that only does well when markets go up, not a good idea. And who was it yesterday or 2 days ago put out a piece saying that the next 10 years, in terms of with interest rates this low, the next 10 years won't look like the last 10 years. And so investors have to take a shift on that. So act now.
Okay. Well, I think that's a good note to end on with some active advice for everybody. Thank you so much for joining me once again.
Thanks, Charlotte. Happy to be here. Thanks.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Paul D'Souza with Sightline Wealth Management.